Welcome to today's Explainer. I'm stepping into the role of a senior equity analyst today to brief our investment committee on absolutely the most critical stock in the entire market right now, NVIDIA. Look, we're dealing with a company seeing explosive, unprecedented growth, literally an 85% year-over-year revenue jump. Yet, there's a paradox here. At times this year, the stock is actually lagged behind its peers. That tells us the market is starting to price in some very real, building structural risks. So, today, we're going to unpack that exact divergence.
Let's anchor ourselves right away to the sheer magnitude of NVIDIA's current scale. Jensen Huang really hit the nail on the head when he said they are building the infrastructure of the AI era, and the world is racing to build it. Guys, this is not just hype. The numbers are frankly staggering. We're talking about $81.6 billion in revenue in a single quarter. To put that into perspective, that one quarter entirely eclipses what NVIDIA generated in its entire 2022 fiscal year. The stakes of this technological supercycle are just astronomically high.
To systematically evaluate this complex stock today, we'll start with their data center financial engine, weigh the micro and macro headwinds, explore the modes in the shift to inference, map out the AI expansion, run the valuation numbers, and wrap up with our 6 investment pillars.
Part 1. The data center financial engine, the trillion-dollar core. First things first, we have to establish what NVIDIA actually is today. Their legacy as a PC gaming company, that is completely over. Today, NVIDIA is fundamentally a pure-play data center infrastructure powerhouse.
Just think about this breakdown. A staggering 92% of their massive Q1 revenue is concentrated strictly in the data center segment. Gaming is down to just 5%. Now, on one hand, this means they're perfectly positioned right at the center of the world's most important technology spend, with hyperscalers shelling out hundreds of billions. But on the other hand, that creates an extraordinary concentration risk, and honestly, that's exactly where the market's hesitation is stemming from. Moving to Section 2, Micro and Macro Headwinds. If we're going to recommend putting capital to work here, we absolutely must look at these structural headwinds with our eyes wide open. The most glaring macro headwind right now? Geopolitics. Tracing the timeline of recent events, the reality hits hard. Due to ongoing U.S.-China export controls and trade policies, NVIDIA is facing severe volume caps on their advanced chips, like the H200. And in retaliation, domestic bans in China have essentially zeroed out NVIDIA's recent high-end revenue over there. So, geopolitics has effectively locked NVIDIA out of a market that represents roughly 20% of the global semiconductor space. That essentially hands market share right over to domestic competitors like Huawei. Now, we really need to untangle the broad macro constraints from the micro execution risks. On the macro side, it's not just tariffs. We're dealing with a higher-for-longer interest rate environment above 5%. That makes borrowing cash to build a $50 billion data center way more expensive for NVIDIA's customers. Plus, there are physical power grid limits. You literally can't plug these GPUs in if there's no electricity to run them. But on the micro side, we've got execution risks. The next-gen Rubin platform has faced some delays, and most dangerously, NVIDIA's biggest customers, Google, Amazon, Microsoft, are building their own custom AI chips known as ASICs, just to save on costs.
Section 3. Moats and the inference shift. This brings us to a massive, fundamental transition in the AI lifecycle, and a really serious question about NVIDIA's greatest competitive defense.
So here's the question. Is the vaunted CUDA software moat actually safe? For almost 20 years, NVIDIA's CUDA software ecosystem has been an impenetrable fortress. With over 5 million active developers, it basically guarantees that if you want to write AI software, you do it on NVIDIA hardware. But we have to ask if that moat can survive the industry's massive shift and how compute workloads are actually handled. The crucial point here is the shift from the training era to the inference era. NVIDIA completely dominates training, actually teaching the AI models. But inference? That's when you actually use the models, like asking a chatbot a question. And Jensen Huang himself admitted that the CUDA lock-in simply does not apply to inference. When running inference at scale, customers only care about raw throughput per dollar. And that opens the door wide open for those custom hyperscaler ASICs we just talked about, along with open-source software like Triton, bringing a very real risk of margin compression over the next 5 years.
All right, Section 4, AI expansion and physical AI. Because to really understand this company, we have to look past those headwinds and visualize the unbelievable demand trajectory that is still coming.
The absolute foundation of this growth lives deep inside cloud data center server racks. Hyperscalers are slated to drop an estimated $725 billion on AI infrastructure in 2026 alone. The entire order book for the current Blackwell generation is completely sold out, and there's visibility into $1 trillion of combined revenue for the Blackwell and Rubin platforms through 2027.
But the growth narrative actually moves out of the server room in 3 distinct waves. Wave 1 is sovereign AI, with governments around the world spending tens of billions to build their own domestic infrastructure. Wave 2 is agentic AI. This is where AI doesn't just chat with you, it executes complex multi-step workflows. And Wave 3, that's the ultimate wildcard, physical AI. We're talking about deploying AI into autonomous vehicles, manufacturing, and robotics out in the real physical world. Management sees this as a $100 billion segment target by 2027. This is exactly how NVIDIA plans to keep growing.
Section 5, Valuation and Capital Return. Let's step back from the tech for a second, bring this debate down to raw numbers, and evaluate the stock's valuation against its explosive growth.
When we run our scenario models for conservative, base, and optimistic cases, the base case really jumps out. Even applying a completely reasonable 25 times price-to-earnings multiple, which is actually a discount compared to NVIDIA's historical peers, we land at a $307 price target. That offers roughly 37% upside. The stock is currently trading at a PEG, or PEG ratio, of about 0.62. And remember, anything under 1.0 means a stock is trading at a discount to its own growth rate. Basically, the market is pricing in a severe slowdown that simply hasn't materialized yet.
And then there's this number, $80 billion. Management just authorized a massive $80 billion share buyback program. Combine that with a 24 times dividend hike and a solid commitment to return 50% of free cash flow to shareholders. Look, you do not hand out $80 billion if you think your core business is about to fall off a cliff, right? This aggressive capital return program acts as an incredibly powerful long-term value floor for the stock, really mitigating some of that macro volatility.
Finally, Section 6, the 6 investment pillars. We've weighed the structural headwinds against that massive physical AI growth opportunity. It's time for my final verdict to the committee. My recommendation to buy rests exclusively on these 6 pillars of the long-term investment case. 1, we have unprecedented demand visibility all the way through 2027. 2, the valuation is highly compelling at a 24x forward PE and a 0.62 PEG ratio. 3, their customer base is successfully diversifying away from just hyperscalers into sovereign and enterprise AI. 4, that massive $80 billion buyback acts as a major catalyst and a price floor. 5, despite some brief delays, their cycle of releasing new architectures annually is still incredibly strong. And 6, the macro capex supercycle is not slowing down, it is actively accelerating. These pillars prove the underlying fundamentals remain historically strong, even with the clear structural risks. As we wrap up this explainer, I want to leave you with one final thought to anchor your decision. NVIDIA occupies the single most critical platform position in technology today, much like Microsoft did in the PC era or Apple in the smartphone era. Now the headwinds, custom chips, export controls, the shift to inference, those are very, very real. But so is the rapid shift toward a physical AI world. So, will NVIDIA dominate this next massive transition, or has the market correctly priced in the top? It is literally a trillion-dollar question, and now you have the data to decide. Thanks so much for joining me today, and keep learning.